Welcome back to post-Thanksgiving, pre-Santa Claus rally. We talk money. We've got Nikki, Travis, and yours truly. And we're going to make this a quick show. We've got a lot of stuff going on, so we're going to just power through this and cover some charts, talk about the macro stuff. There's a lot of weird things that are happening today. Europe's popping. Even GME is up. And we got Bitcoin that has been consolidating and slowly stair-stepping to the upside. What is the big theme that you guys think people need to be paying attention to right now?
The big bad central banks have been sidelined.
Have they
Investors, they have been tamed. Yes, Jerome and his cronies. Well, maybe not fully tamed, but the market's definitely getting more comfortable with where things are headed going into 2024. You know, some strength on the US side in terms of the economy. And also, of course, the big positive is the inflation numbers coming down. You know, who would have thought? Who's been talking about that the last few months, that inflation numbers were going to cool and that people were getting way too worried about interest rates?
I know of a show that has been ringing that bell in the face of all the FUD.
Yes.
Yeah.
I think his name starts with a T.
Yeah.
Start with a
Stock
T.
Geek TV.
But if you've been missing out on the show, hopefully you've at least been subscribed to the Daily Doe, dailydoe.co, where we've also been writing a lot about the macro stuff and crypto, and we've had a lot of good takes this year so far, especially for the first year of the Daily Doe.
Yeah, I certainly think so. Yeah, and we've been, you know, in the right place at the right time this year, both in crypto and in stocks. It's felt really good to feel like we've got a good pulse on what's happening in the market. I think 2024 has definitely we've got some open questions. I think, you know, we had a pretty good playbook for 2023. 2024, I think there's starting to be a lot more questions opening up now about what it looks like. But investors right now are pretty happy. I mean, the S&P's up 10% in the last month. I think the Nasdaq's up 12% in the last month, and Bitcoin's up probably twice that.
a little bit. Yeah. 40% or so over the last month and up over 100% on the year. One thing that we don't really talk a lot about, but I noticed today was the DAX was up. So Europe, Germany was up pretty big. I guess there was an inflation print that was much lower than where they've been all year. What happened there?
Yeah, it's kind of wild to see if you're looking at, you know, how inflation is cooling here in the US, you'll be shocked to see how much it's cooling in Europe. And part of that, of course, is I think, you know, Europe's experiencing a bit of a weaker economy, but they're seeing a lot of the same drivers of cooling inflation as we are as well. So, you know, Germany was printing inflation figures in the 6+% year-over-year range just back in July. And here we are, fast forward just a couple months to November, and they're printing in the low 3% year-over-year range now. So their inflation is rapidly cooling. Also true across a number of other countries in the EU. And so that is obviously giving investors some optimism there that central banks will be able to actually reduce rates and ease some of that pressure on the economy, maybe going into early 2024. So that's definitely good news for Europe in my mind. And, you know, it doesn't necessarily mean that we're not going to have inflation at all in the US or Europe, or that the inflation beast has been fully tamed, but it does suggest that, you know, the policies have started to really have an effect, particularly in places like Germany. So
I want to give you guys an anecdotal story from this morning that I thought was really interesting and kind of ties in with all this stuff. So I was talking to my buddy who's been doing a lot of building, both commercial and residential recently. And he was showing me like different pieces of lumber and different just components that go into building. And he's like, man, you know, in 2019 or, you know, before, during COVID, you know, the price of this was $1 and now it's $2 or $3, or this plank used to be $20. Now it's 60. And like, I know, you know, lumber futures have come down quite a bit, but on the retail side, like a lot of people in the building industry are still getting squeezed. And he knows somebody that works for Fannie/Freddie somewhere in the foreclosure department. And I guess internally they are predicting a lot of foreclosures starting to happen over the next 6 to 9 months. So it doesn't, my opinion is we're not in a 2008 type scenario where everybody's just overextended on the lending side. You know, maybe vehicles, that's a completely different story, but on the real estate side, yeah, things could get a little sketchy here. And it's good to see that rates are coming down. Actually, this morning we had rates come out and they were down. What were they down, guys? Pull this up. But it was basically interesting to hear him talk about that, because he has been affected by all of this stuff, and mortgage rates are down 7.37 from 7.9. So that's good to see that they're starting to pull back a little bit.
Yep, and that's been helped by a decline in yields, even at the longer end of the curve, where there's a lot more variables that can affect 10-year and 30-year yields, but even those have been coming down as well significantly. I think the 10 years down just in the past week from like 4.5 down to 4.25. And then I think in the last month, it's obviously down from when we had that peak hysteria over rates where the 10-year and the 30-year were peaking above 5. And I think there was people like Rick Santelli going on CNBC saying that they thought the 10-year could go to 12 or 13%. And I'm like, come on, like you're just like, that's not even really in the realm of possibility in the near term. But in any case, we've gotten some relief, obviously, from the CPI helping, and some of the Fed speakers have been starting to cool their language a little bit. They're still going to be very stubborn about saying that they're going to say they're not going to, the Fed is not going to reduce rates yet. But, there are people, even like Bill Ackman is now saying that he thinks rates could get cut in early to mid 2024 because, real rates have risen. And if inflation is falling, then, the Fed short-term rate should fall as well. So yeah, that's good news. That's definitely good news. That's very clear news, because anybody who has to refinance debt or anyone getting a new mortgage, things like that, like you pointed out, it's going to look a little bit cheaper, a little bit more affordable if we get rates coming down.
Yeah. And I know car prices had their biggest decline in recent years recently. So, dealers are getting stuck. If you look on YouTube, it's like all the auto dealer influencers are freaking out, saying there's an implosion. And I think that needed to happen, right? Like trucks were just way, way, way too expensive. And now nobody can afford the payment. And so there's a lot of repos. Nick, how is the consumer right now?
Funny you ask. I just spent the past week, I wrote in the Daily Doe 2 sessions in a row about retail earnings and what I've been finding. And basically, I guess the too long didn't read is there are spots of weakness, but there are also a lot of bright spots that I think the people are ignoring completely. And I think that when we talk about the consumer, we need to talk about what are they spending their money on and where are they spending their money? Because when we look at the recent data that just came out about the biggest travel day, TSA came out and said they had the biggest travel day ever. Black Friday shopping, Shopify came out and said record, right? We had a lot of other pieces of data that came out and businesses saying that they had pretty decent sales. So I think that the consumer is obviously still consuming. We know that by retail data, but what we also know is they're being choosy on brands. So if we look at, department stores like Walmart and Target, yeah, they have seen a lot of consumer discretionary weakness, but that doesn't mean consumer discretionary spending isn't happening. It's absolutely happening. We're seeing clothing brands like Abercrombie and Fitch have some of the best comps in the industry right now, 30% revenue growth year over year, which is insane. I can't even describe to you how insane that is, considering the turnaround that they had and considering the weakness expected from the consumer. Hollister, revenue up 11%. Anthropology, positive revenue growth, which is owned by Urban Outfitters. Free People, owned by Urban Outfitters as well. Positive, very positive revenue growth, 22%. These are very high comps for retailers. So we have to first put it that way. And this is all happening post the pandemic. So they're hanging on to a lot of those gains that they've already had from the pandemic. Aerie is another brand, Elf Beauty, Amazon, their retail side of the business, XAWS. So there were a lot of brands that showed that the consumer is still spending. even on the lower income consumer side, there are brands there like TJ Maxx and Ross stores. So really, all in all, there's good and there's bad. Big box retailers are struggling. Kohl's is struggling. Target is having some issues on that consumer discretionary side, but there's also a lot of good too. So I think that it's just one of those things that I've been talking about forever, this push and pull, and the haves and have-nots in retail it's really showing itself. But besides, because that you can kind of pick and choose your narrative from retail sales right now. But besides that, we are seeing checkable deposits come down. So this is something that I'm going to be writing about in the Daily Doe, kind of putting a lot of data together. But we are starting to see money being taken out of checking accounts, but we're still above pre-pandemic levels, right? So people still have money, but who that is, of course, there's going to be a divide. There's going to be people that are putting on credit card debt that don't have cash in the bank. And there's going to be people that, the boomers that can sustain the economy with their bolstered accounts and their money market mutual fund accounts, and so there's definitely going to be a divide of wealth here that we've seen historically. And I think that's going to continue. Trav has talked about before the credit card delinquencies that we need to keep an eye on. And, I totally agree with that. So overall, there are things you can kind of pull all over the place, good and bad.
Yeah, we're seeing on the crypto side too, just a lot of risk tolerance for, shit coins again, and obviously Bitcoin. But, even some of the meme stocks I've noticed today, like GME is up pretty big, and it doesn't feel like full like 2021 euphoria, but it's pretty interesting, at least in crypto, in the face of all the SEC regulatory stuff and Binance and FTX. And, I can't remember if we talked about this last week. CZ, the founder and CEO of Binance, is, settling over a $4 billion lawsuit, and it's still unclear if they're going to try to do prison time. And so there's still like a lot of just looming FUD in the crypto space. But even there, we've seen alts up quite a bit over the past couple of months. I mean, just on the large caps that, we've seen a lot of stuff up 20, 30, 40% or more. But what's interesting with that though, is like, even though alts have been climbing, Bitcoin dominance continues to climb. So it's just wild how Bitcoin just continues to be a magnet for capital. But yeah, what are you guys seeing out there in stock land? Are you noticing, what I call like popcorn season, like where you're starting to see a lot of the meme coins popping off? Or is it kind of a mixed bag still, or is it still large cap that's dominating, or is there more breadth to the gains?
I feel like I've noticed, Trav, correct me if you're seeing something different, but we are seeing a lot of the beaten up names, even like tech names that were beaten down to a pulp bouncing. So we're seeing, like, I looked at my portfolio today and I was like, oh, I'm seeing like Etsy bouncing, and Square bounced from the bottom, hardcore, and many, many others. Lululemon is breaking out or trying to break out again. So we're seeing a lot of the beat down stocks that were at 52-week lows or multi-year lows finally getting some relief, and buyers stepping in.
Yeah, we certainly are. And we're seeing a lot of the high beta stocks rallying as well. And so you've got things like Open Door up 40% in the past month. You've got Wayfair up more than 40% in the past month. Names like Carvana and Lyft and companies like that, whose stocks have been generally beaten down over the last 2 years. But when we do have higher beta rallies, they tend to rally the most. And we are seeing that again here just in the past couple of weeks. And so I would say, yeah, certainly we're seeing a lot more stocks that are joining the rally and joining the party, so to speak. Now, it does always make me a little bit nervous when we get the biggest moves happening in, some of these more speculative stocks, because that's like the sugar rush, and it can fade out pretty quickly. And those are also the stocks that can move, that can lose the most, very quickly. So yeah, it's hard to look at that and say that that's necessarily super healthy. But I think if you look even outside that, we've seen pretty good breadth overall just in the past couple of weeks. Like I said, S&P up, but even the Russell has been up quite a bit this month. So I think
Oh,
generally
yeah.
it looks pretty good.
We have to look at the S&P 500 price action because it's insane. Like looking at how strong the S&P chart has been in the last, quarter of the year so far, right? Um it's takes my breath away. Like
Yeah.
when you think about all of the negativity and the doom and gloom that we've had to kind of navigate and try to avoid making bad investing decisions around, right? Getting scared, and then the market does this, and it's just quite interesting to see how strong we're less. What are we now? 5% from all-time highs, if that, somewhere
Oh,
around
less than
there.
that. Yeah.
Yeah.
I
So,
think.
or not all-time highs, but all-time
Yeah.
highs. Yeah,
Mhm.
yeah. So, that to me is quite shocking, and I'm hearing price targets in the S&P of, 5,000 plus now. That's starting to happen. I don't know if you guys have heard those, but,
I mean, that's
it's
not that far away, especially if we get a squeeze. It's wild how strong a lot of charts are looking, not just in crypto, not just in stocks, but also gold. I mean, look at this thing. This looks like it wants to rip people's faces off.
it does.
But
It really
I think if
does.
we snap 2100, 2700 is, or excuse me, 2600 ish is my next target. That's where the 100% Fibonacci extension is from when the whole ETF thing got started back in the early 2000s. So it could take some time, but I think I said this a few weeks ago that I thought this could happen relatively quickly, which, and when we're talking about gold, I mean, maybe a year, but yeah, a lot of things just looking super strong.
Yeah.
Yeah.
I wrote in the Daily Doe actually about what, because people have been arguing, is this the new bull market or is this a bear market rally in the S&P 500 specifically? And I am of the opinion this is a new bull market. By when you look at the historical price action of prior bear markets, I do think that we are in a new bull market. So that's my personal opinion. This price
Mhm.
action is not price action of a bear market rally when you look at the 2008 financial crisis, the tech bubble, 2020. It's just not acting the same way, in my opinion, from a
Yeah.
technical analysis perspective.
Yeah, at
Yeah.
least after the squeeze, right? We were making lower lows, lower highs, and then the squeeze, the short squeeze a couple weeks ago was just super, super strong. And I'll pull the chart up for you guys watching the video. It was like once we snapped up above this 4,400 zone and that broke above the 100 period moving average, any short that was in that day likely had stops placed behind that area. So we're taking a little bit of a pause. We've been seeing falling volume and kind of consolidation, which is typical around, pre and kind of during Thanksgiving. But yeah, it'll be really interesting to see if we get that Santa Claus rally going into December. Trav, do you think we're going to see that, or is there like a looming black swan that could potentially smack us in the face?
Yeah, man, black swans are black swans for a reason, right? We don't
Come
see them
on, man,
coming.
predict them. We're going to call them
Uh,
glass swans because we can see right through them and we know what they're
yeah.
going to do.
I don't see anything on the near-term horizon that spooks me too much, to be honest. Like I've said, we're watching things like certain leading indicators, things like the consumer delinquencies, which have been ticking up and are now above the just pre-pandemic levels. And so they're not at concerning levels that would make us think we're headed right into recession. But if they keep rising at this rate, then I think we have a problem. But, that for now, it's hard to just look at something like that and say, oh, it's all over. There are other things that look really strong. GDP for Q3 was above 5%, above 5% GDP growth in the US for Q3. I mean, that's just kind of shocking. Of course, things like fiscal spending, but also things like business investment have been driving that. So yeah, it's pretty good. The job market's still holding in there pretty well. I don't see that changing a whole lot in the month of December. We don't typically see a whole lot of movement in the job market there in December. So I think we're going to have to wait till early 2024 at a minimum to see if anything changes or shifts in a major way. And I keep saying, Fed policy is going to play a big role in what happens in 2024. And I do think we could get this tough period where the Fed is slow to actually cut rates, and then the markets have to respond with a big pullback. Especially if we get a little bit weaker economic data at some point. And that could very well be a very nice buyable dip. And so I do think that's still a strong possibility. It's even in bull markets, we get pullbacks. And so I think that is still a possibility for 2024. So I hope it happens because, right now it's all looking like gravy out there. It's all positive. And one thing I will say, though, is if you are looking to potentially add some tail hedges, they've gotten quite cheap. Volatility is now quite low. You've got everybody cheering on the markets, and you're positive in the green on crypto and stocks, gold, and a lot of different asset classes, even bonds now joining the party. So it could be time to start thinking about maybe some tail hedges here and there. But I don't see anything on the near-term horizon that spooks me too much.
All right. So Trav just shorted $1.6 billion of the NASDAQ. Michael Burry 2.0. Here we go. No. All right. Well, we've got a lot to think about going into the holiday season, but I wanted to bring up the passing of a legend, Charlie Munger. Trav, I know you wrote about this in the Daily Doe today. You came up with some quotes. He has a lot of wisdom, and I think there's some things that we can pull from it, talking about mistakes and patience and lifelong learning. And there's a lot of good stuff in here. I tend to kind of shy away from like investor worship type stuff. I mean, Munger definitely has said some less than intelligent things about Bitcoin, but what's a big takeaway that you got from Munger over the years? Did you study him much? Was there anything that was like something you kind of referred back to or thought about?
Yeah, I got a decent amount of Munger material for over the years, just following Berkshire Hathaway, following Warren Buffett. Warren's really, I think you have to put him up at the top of a list of greatest investors at this point. And of course, Charlie was his business partner for the better part of 40 years or so. And so, yeah, I think he's got a lot of wisdom that's been shared in books, and he's got, Poor Charlie's Almanac, things like that. The biggest things that I've taken away from him, really, he helps me to recenter on the idea as a longer term investor of patience. And that's a big one, because a lot of my biggest mistakes have been selling winners too early. And so when I go and read Charlie, particularly his stuff about investing and how Berkshire Hathaway has made their most, how they have really made money over the years, has been to, find the best of the best companies and then just hold them for a really long time. Even their stake in Apple, they've now held for a number of years, even though Apple kind of looks overvalued right now. It's not really growing this year, but yet it's still trading at like 30 plus times earnings. And yet, Berkshire's not selling. They're still holding. They may hold that for another decade. I mean, they've held Coca-Cola and Geico for decades. They bought them at the right times, and then they just hold on. And so, looking at their results and seeing, what they've said about patience and about the value of just doing nothing most days as an investor is something that I keep going back to, just to try to, make sure that I remember day to day, like, okay, you don't need to be too active. Some days, even if your stocks are a little overvalued, maybe you don't sell, maybe you hold on to your good ones. I think that could even apply to things like Bitcoin and crypto, where I've maybe overtraded it at times. And I'm sure we all have. And so that's something I think is a really good takeaway from the investing side that a lot of people should just keep drilling into their heads, is just the value of patience as an investor.
Well said. And the quote you put in there is, the big money is not in buying or selling, but in the waiting. It's waiting that helps you as an investor. And a lot of people just can't stand to wait.
It's so true.
Yeah.
We feel productive when we're taking action and when we're pressing buy and sell. But like he says, the profits are in the waiting. And I'll give not an anti-Munger perspective, but just, some thoughts that I had. I was like, look, he was really good at a specific style of investing, right? But that doesn't mean that, like, it's weird how people look at some investors, be it Munger or Buffett or Michael Burry, where they kind of put them on this pedestal, and they think that because they're really good at a style, or they had a good call, that means they're like knowledgeable in all aspects of investing. And like, I think we all make really stupid mistakes in our investing and trading journeys. And one thing that he said is, he's called Bitcoin rat poison. And, he said several quotes that I hear him and I'm like, what is he saying? Like, why is he saying that? Is he, I don't know. Is he just ignorant? No. Is there an ulterior motive there? Like, what the hell's going on? But at the end of the day, you know, I think it just proves that, like, number one, you don't have to be an expert in everything to get really rich. Like, you can just pick your niche and you only have to get rich once. And then number two is we shouldn't worship these famous investors. Like they have something special that we can't get, right? Yeah. There's some people that are smarter than others. There's some people that have access to capital and, you know, more privileges in life. But at the end of the day, you know, if you're young, you have something that the older dudes don't have, you know, you have time on your side. So I think balance is just key when it comes to looking at these people.
So
That's
well
funny
said.
you say that. This aligns perfectly with something I think I was talking to one of you guys this week about. Someone replied to one of my tweets and said, basically, if whatever Warren Buffett invests in, that, you know, that's what I'm investing in. Meaning, it was around Bitcoin, and this person was basically saying Warren Buffett doesn't invest in Bitcoin, so I'm not going to invest in Bitcoin. And I think what you tweeted, Chris, is the perfect way to put it. Because I was trying to figure out the words to explain why that is a short-sighted take. And even though we respect Warren Buffett and Charlie Munger, like, we absolutely, but they are value investors, and they probably did not invest heavily in technology, which was one of the most one of the best performing sectors that you could have invested in. Granted, they have Apple and other you know, names, but they were focused on value. Coca-Cola over, you know, Tesla, or Geico over you know, and insert Facebook, I don't know, Meta, whatever, you know. So I think that it's important to realize that you don't have to be an all or nothing. You don't have to only focus on one strategy. And that's kind of what a lot of people get themselves backed into. They worship these guys, and they both were against Bitcoin, right? But Bitcoin might end up being one of the best opportunities, best investing opportunities that we see in our lifetimes, period. And so ignoring that and being all or nothing and worshiping others, I think, could get you into some trouble, because everybody has different risk tolerance. You know, everyone has different strategies that they want to take advantage of. And we love the idea of being an all-around investor. You don't have to be all or nothing. So I really love that take on your Twitter about that.
Thanks. Yeah. Also, I mean, I know I already brought up Burry, but it's like, how many people followed him in on the shorts or stayed out of the market because he got short? And we saw how the media blew out of proportion the size of his short, and how when stuff like that, you know, like fear porn, it just spreads. And so whether it's a investing style or a specific trade, it's like, no matter what you do, you still have to accept the risk for yourself and make sure that you're making the best decision for yourself. And for some people, that is just, you know, following Buffett's strategy and saying, I'm just going to buy the S&P 500. For other people like us, it's like, we want to do it all. You know, we want to be active. We want to trade. We want to invest. We want to find startups. We want to have passive portfolio. We want to have active, you know, so it's a choose your own adventure. And I think the biggest point is you don't have to follow someone exactly to make a lot of money, because there's so many ways to skin this cat.
And these investors can be wrong at times too, you know, as we've seen over and over. So nobody is perfect. No investor is perfect, but mad respect, and, you know, rest in peace, Charlie Munger, for sure.
And on that, we'll go ahead and wrap this up. Nikki, I know you got to run, but guys, make sure you're subscribed to the show. Also, go to dailydough.co, get our newsletter every Monday, Wednesday, and Friday. And if you're not in the wealth building community, go to wetalkmoney.com/community, and we will see you in Discord and our live classes. All right. Well, guys, thanks for joining me. We'll see you next time.
See you next time.